Welcome in, folks. Hope everybody's having a tremendous day out there as always. I got something very serious I want to show you guys here at the beginning of this video, okay? Something that we showed in our weekly investor report inside the private stock group. I want to go through that. We just witnessed the biggest drop since 2022 in regards to something very important here. So I want to show you guys that it's actually the biggest drop since the fourth quarter of 2022, essentially. It's pretty dramatic. And so I want to show you guys what's going on as far as that goes, okay? Then we're going to get into this subject actually around retail investor sentiment out there. I made an interesting post on X today, really just to kind of gauge how people are feeling out there. The results were pretty fascinating. So looking forward to showing you guys that, okay? From there, what we're going to get into is Cake stock was one of the stocks I featured on 4 Stocks I'm Buying March 2025 edition, which was a video I created last night for you guys on the main channel, Financial Education, right? And I want to show you guys Cake projections so everybody really understands the opportunity there, because I didn't show Cake projections in that video. So I want to show you guys on 1000X the Cake projections and how much the valuation is going to change that company over the next 4 or 5 years, because I think it's an important subject to dive into. And last up here, Adam Pitapaka and everybody's favorite bull, Tom Lee, went on CNBC about an hour ago or so and spoke about their views on the market, where we're headed from here. So I think a lot of you guys are definitely going to enjoy that, okay? Appreciate everybody being here. As always, thank you so much for being here, folks. One thing only I need from you guys, and it's for you to take 1 second out of your day and just hit that like button down there, okay? Hit the like button on this video. That's all I need from you. I appreciate you doing that. Additionally, if you want to subscribe here, you can certainly subscribe. We are now, I think we're over 81,000 subscribers here on the Reaction channel. So I'm very fortunate, and thank you for everybody that always joins me day in and day out. I appreciate you guys always for being here. Additionally, if you're looking to take your investing game up to a much higher level than where you're at, you want access to my private stock group, private wealth group, 1000xstocks.com, the software I use each and every day. You can apply with the pinned comment down there. Click on that, fill out a form. We'll see if we can get you access to everything, take you up to a higher level, maybe the end of this week or maybe over the weekend, okay? Alrighty, guys, so let's start out here in my private stock group. I want to show you something very important we posted for all the members of the private stock group here, okay? So each week we do this investor report, okay? And it's basically, I understand, everybody's got stuff going on, right? A lot of people cannot focus on the market on a day-to-day basis like I do, right? You know, people got jobs that is not related to the stock market. People have their own businesses. And so it's very unrealistic for everybody to be tied into everything that's going on in all different reports. So that's why I created the investor report, which we post inside the private stock group every week. And it goes through so many different slides of information. So it keeps you up to date on everything that's going on that's really important out there in regards to the macroeconomic environment, in regards to the markets, those sorts of things, right? One of the first slides we show here is very, very important. It's called the AI Investor Sentiment, okay? And this is a survey they've been doing since the 1980s, all right? And how investors are feeling about the stock market over the next 6 months. Something you always want to keep an eye on. Well, here recently, we have just witnessed the worst number in terms of how many people are bearish on the stock market that we have seen since 2022. Yes, that's how bearish investors have gotten here, okay? Over 60% of investors are bearish on the stock market for the next 6 months. That's a ridiculously high number. That's literally around double the percent that is usually bearish on the stock market. The historical average is around 31% of investors are bearish, right? Generally speaking, the market's going up most times. People should feel more bullish than bearish, right? And then neutral should be the second biggest category. For over 60% to feel bearish definitely feels like, wow, a lot of people have very poor sentiment. Now that leads me into this subject, because I posted this on X here today, just because I wanted to gauge like how people are feeling about the market right now, okay? And I said, you know, obviously good day in the market. I was up huge today in my portfolios. I'm sure a lot of you guys were up big in your portfolios here today, right? And I wanted to get people's opinion, obviously with the weakness in the market here recently, right? The Nasdaq as of yesterday during the trading day was down about 10% from where it peaked out at not too long ago. And so I said, which of these two do you think it is? Is it dead cat bounce, or is it a real deal Holyfield rally? And what I found, and you can go through that post on X, what you're going to find from the comments, this is a pretty funny one, is a dead cat bounce. Dead cat bounce. A lot of people feel like it's just, we got more red ahead. It's just a dead cat bounce, and and that's all it is. It's not a real deal Holyfield rally, and ultimately, a lot of investors feel like, you know, we're headed back down. And so it just goes to show you how poor sentiment is right now. Because I could tell you, if I made a similar post like that, asking a month ago, the feeling from the retail community was overwhelmingly bullish a month ago. Same thing 2 months ago. overwhelmingly bullish. Like people weren't even thinking about the market dropping. Like market's only going to go green and we got a long way to go here, okay? So it just goes to show you how, I always tell you guys this, the market can shift so fast sentiment, man. It can go from people feeling so great, only thinking the market's only going up, to all of a sudden, doubting the market and, it's dead cat bounce and we're going down more and it's going to be more red ahead, Red Dead Redemption, right? It's fascinating. And on the flip side, it can flip the other way. But the one thing I will say, it's very important everybody understands this, the market sentiment can shift negative much more quicker than it can shift positive. And we witnessed this in 2022. 2022, especially after, Russia went into Ukraine, oh my gosh, sentiment got so bad so quickly. Then we obviously went through the whole 2022 drop. And then it took, honestly, almost 2 years to get a really positive sentiment back from the retail community and from investors in general. Took almost 2 years. Like market rallied huge in 2023, right? Market rallies huge in 2024, but it honestly didn't feel like until the back half of 2024 that the sentiment started feeling good again. If if you guys follow me on this reaction channel the last couple of years, I reacted to so many videos of so many of these Wall Streeters bearish on the stock market in 2023, bearish on the stock market in 2024. And it didn't seem like we got to kind of more of a overwhelmingly kind of bullish feeling really until the back half of 2024. And so just always understand that, man. It can go from great sentiment, it's nothing but blue skies, to all of a sudden, it's nothing but a hurricane in front of us, right? No, cake. I wanted to show you guys something very important in regards to projections around cake before we get into the Tom Lee and Adam Pietapaka video, okay? Because that was one of the stocks I featured on 4 Stocks I'm Buying, March 2025 edition. That was a 45-minute beast there, okay? So here's the thing you got to understand about cake. Cake trades at very low P ratios, forward Ps right now, okay? And the reason being is, revenue growth hasn't been the most exciting in the short term for cake, right? We kind of thinking about cake as like a 4 to 5% revenue grower. But what you're going to see play out for cake over the next number of years here is a massive build out of locations, because their flower child concept is now, officially going to be spread across the whole United States of America. Flower child is even more so in a much bigger impact, because they're talking about 700 domestic locations over time. They only have 38 locations right now. So what you're going to likely see is major revenue acceleration for this company for years to go in the future, okay? And so the way I kind of think about it is 25 new locations are coming in 2025, which is by far and away the most they've opened in a year, right? But I think they could potentially double that in 2026 and take it to like 50 locations next year, especially based upon the cash they raised here very, very recently. And additionally, I think they could take this longer term up to 70, maybe 100, maybe even over 100 locations per year if we look at a few years from now, okay? And so what that's going to do is that's going to raise revenues dramatically, because understand the comp restaurant sales are going up for the company. Look at the Flower Child they mentioned on the latest conference call talking about 11% comps. So that means they're doing way more business in each Flower Child. They're way more productive. They're making way more money, right? Now you talk about spreading out a ton more locations. Whew, I mean, it becomes pretty dramatic. So the way to kind of think about it is 2025 revenue probably is up 8% or so, right? Maybe worst case scenario, it's up 7%. Best case scenario, maybe it's up 9 or 10% for revenue for 2025 for cake. But I wouldn't be surprised if in 2026 they massively increase the amount of locations they have and revenues up like 11%, give or take, let's call it 2 percentage points there, right? And then we can call it 14%, because I bet you though by 2027, I wouldn't be surprised if they're opening 70 to 100 restaurants a year. And then we could be talking about revenue that's mid double digits by that point in time, right? If not higher than that. But I would say 14%, give or take 2 percentage points there, 2 or 3 percentage points, right? And so what ends up happening is as your revenue growth accelerates, right? You start basically having a move up in your P ratio, where right now people might look at cake and they say, okay, we're only going to value this company at a 15 to 20 PE, right? All of a sudden, if they start increasing their revenue growth to, let's call it high single digits, close to double digits in 2025, which is very possible, then you kind of got to say, you know what, okay, this company has much stronger growth. We're going to kind of put them in the 20 to 25 PE. If next thing you know, they start doing low double-digit revenue growth, then you start saying, okay, this company's actually a pretty good growth machine. We're going to value this company somewhere between a 25 and a 30 PE. Then if they start getting to like a mid double digits growth rate, right, 14, 15%, somewhere around there, you start saying, okay, I got to start valuing this company at like a 35 or a 40 PE ratio, right? And this is just how you have to value these companies that are in the restaurant sector, which means if this is what ends up playing out for Cake, right, we could be talking about a $200 stock come 2028. Best case scenario here, in my opinion, right? Which is pretty darn attractive when the stock price is $50 right now, okay? So, moral of the story is, and I get to get a fat dividend yield along the ride. So, I hope this better illustrates the point on why I'm so bullish about Cake, why I want to buy so many shares, regardless of whatever happens in the market and tariffs and, you know, worries about recession, all that stuff. Like, that's going to be what that's going to be. The moral of the story is the next 10 to 20 years look insanely great for Cake. And so I do not care what happens in the next 10 to 20 days and the next 10 to 20 weeks in regards to Cake. It is irrelevant to me. Even the next 10 to 20 months is irrelevant to me in regards to the drama out there. I'm thinking about the next 10 to 20 years, and for Cake, like, this is likely going to long-term be a stock that's valued at several $100s per share. And so to be able to get shares at $50, give me every share you can, okay? So I think that's important there. And once again, if you didn't get to check out that video and you want to watch that, it's on my main channel, Financial Education there. It looks like about 78,000 people have gotten to see it so far, okay? Alrighty, let's get into this one with Adam Peter Plaka and Tom Lee.
Is the managing partner and head of research for Fundstrat. Both are CNBC contributors. We're lucky to have you both together.
I got some boba today. Anybody drink boba out there, or is this only a Vegas thing? Like, I don't know. Like, you know, boba's a big thing outside of Vegas. But in Vegas, we have boba places all over the place, in these tea shops and things like that.
Today, welcome, guys. All right, Adam, just give me your assessment as you watch what is a increasingly headline-driven market.
Yeah, I mean, look, as you know, we think it's going to be choppy. I'm still optimistic that on the other side of this, we could get back toward, you know, revenue growth and you know, beneficiaries on the AI front with productivity and margin. So the call we've had is choppy here in the first few months. Then once the management teams understand what the policy backdrop is, they can, you know, deploy productively capital. So I choppy first half, and then we probably get a resumption of pretty good growth.
Tom, you've tried to remain pretty optimistic through all of this. Are you still?
Yeah, I am optimistic. I mean, I can understand why investors are sitting on their hands. I mean, they don't really know how severe these tariffs are going to be, how long they are, but now we're seeing a big price correction, a decline in sentiment, and then something like today, we got a bad ADP jobs report, and the market's actually up, so we're actually rising on bad news, which is a good sign that a lot of bad news is priced in.
But do you agree with Adam that the first half of the year is likely to be a little more choppy, and that you can get through some of these issues here regarding trade, and then you look down the road to tax policy and think that, okay, well, that's going to usher in a better back half of the year?
I mean, in fact, what's just happened in the last
tax policy, excuse me.
Yeah, I mean, what happened in the last 6 weeks is essentially a bear market that has swept through sentiment and positioning, right? Because if you look at hedge fund positioning, it's gone almost neutral, and a huge correction in momentum. So I think it's very possible that March, April, May could actually be 6 weeks.
Okay, hold on. Hold your horses for just a moment. Let's look at what Tom Lee's saying here, without just hearing what he has to say, okay? Because this is a good breakdown here. He says, seen a lot of downside hedging this week. Yep. They were late to that, by the way. You should have been hedging honestly, you should have been hedging in December and January. It was so cheap to buy put options, and it was insane. So people are just late. Like, now they're hedging. It's like, dude, you're way late to this game. Odds of a 10 best day coming are very high. Ooh, that's interesting. And that's kind of an old saying around, well, not just saying, it's actually factual around the best days in the market. You miss a few of the best days in the market, which is once again why you don't try to time the market, and your returns are dramatically lower. Markets are so oversold and pessimistic, a sizable rally is near. And today was a decent sized rally, right? I'm sure he's talking about something even bigger. Do remember Tom Lee went into this year talking about kind of, you know, mid-year was going to be rough for the stock market, and kind of expecting a decent first half and, you know, or a decent, let's call it first quarter and kind of fourth quarter of the market. But he seemed very bearish on like the second quarter, third quarter for the stock market, from what I remember going into
It's essentially a bear market that has swept through sentiment and positioning, right? Because if you look at hedge fund positioning, it's gone almost neutral, and a huge correction in momentum. So I think it's very possible that March.
He says Bitcoin's recent action is a sign of risk on behavior returning. We do not believe a bear market is near, he says. Okay. Yeah, and that's exactly kind of where I've been at as far as that goes. I think next year's full game on what happens, but I think it's, once again, as I explained, and this is very important, everybody understands this, right? The stocks that really run the market are the big tech stocks. And I think just for a lot of them, it's hard to get a lot of those stocks down in any significant way from here. I think Google, Meta, Amazon, even Nvidia, I think it's going to be difficult to get those stocks down. Even Microsoft, I think it's going to be difficult to get those stocks to fall 20, 30%. And that's what you need to happen if you're going to get an actual bear market. You need Meta to fall another 20% plus from here. You need Google to fall another 20% plus from here. Microsoft, Nvidia. Is it possible? Sure, it's possible, but dang, it's going to be hard, man. It's going to be really difficult to get those ones to fall another 20% this year. Right?
April, May could actually be like one of these huge rally months where we're rallying 10, 15%.
Even in March. I mean, as we're sitting here, we're going to be driven obviously by more tariff headlines. We do have to consider the fact that earnings could take a hit. Do we need to reassess that?
I mean, look, I think if stagflation were a stock, it's up off the low.
Yes.
That's why the market has been choppy. People are worried about,
For sure.
A slowing economy, Walmart, consumer confidence, retail sales looking a little light. At the same time, they're worried about, higher prices. I don't think that's ultimately what's going to happen.
So you'd be short that stock?
I would be. I just don't know. Maybe I think Tom is shorted today, and I maybe would say
it's
I maybe would be shorted in a couple months. But I think we're in the same mindset that we'll get on the other side of this at some point, probably in the second quarter. I just think it's hard to get through it until we really understand. If you're the CEO of a company that's a big company and you've got facilities and customers in Canada and Mexico and China, et cetera, I just think you're a little bit, I like his phrase, sitting on your hands a little till you understand a little bit more about how to most productively deploy capital. I think that usually takes probably through April earnings and guidance, and then I'd probably kind of be more optimistic that we have a certain path. So we're in the close enough for, government work, if that's a thing.
I posted something crazy inside the private stock group in the breadcrumbs tab here, a couple days ago. I said the Russell 2000 is the same price it was 4 years ago. Hard to say we had a bull market the past 4 years when the Russell has no gains to show for. And that's just crazy to think about that, right? And then I took it a step further. I said, then to take things, to a higher level, think about how much inflation we had in the past 4 years. If you factor that in, you can make a case that the Russell 2000 has lost 30%-ish versus inflation in the past 4 years. That's wild, man. Absolutely wild to think like the Russell Wilson's down on a 4-year basis and gotten absolutely wrecked by inflation. Jeez. That's not very often, guys. I can tell you, if you look back throughout the, past 60, 70 years in the stock market, right? I'm not just talking about recent history. Go back 60, go back 70, go back 80 years, and look at the Russell over time, right? Go find a time period in any of the past decades where the Russell was down over a 4-year span. I mean, the only time period I can think of in recent times meaning like the past, 20 years or so, where the Russell was down on a 4-year basis, other than right now, was in kind of that 2006 to 2010 time frame. Because if you look at where the Russell was probably back in 2006, and we can pull it up here live, and so we can all look at it together. I would bet you if you pull up the Russell in 2006 to 2010, I bet you the Russell would have no gains to show for it. And that's really the only time period that I can think about in which you would have this essentially going on, right? So let's take a peek here. So this is back in 07, right? So here's 2006, okay, so 2006. And if you look at where the market was all the way out to, late 2010, it was basically around the same level late 2010 that it was in 2006, right? But that was because we had the great financial crisis and massive crash in the market. So think about that for a moment. The same level that means the Russell has gone through its worst time we have seen since the great financial crisis. That's fascinating. That's really, really fascinating. And then once again, to take it a step further, we actually experienced some deflation during the great financial crisis, whereas we've been in an inflationary cycle in regards to the Russell. So usually inflation would be, people would think as good for stock market indexes. Not in this situation, not for the Russell at least. Fascinating. Absolutely fascinating to see that, right? All right, let's keep going here.
Well, you might be losing.
Yeah, exactly. We might get dozed.
I don't know if that's so bullish for you.
I'll take you too. I'll take you too.
I mean, it's one thing for CEOs to be.
Oh, yeah, the whole Doge situation I saw today. Senators are coming out, Congress coming out saying things got to get approved past us. We like what you're doing there, but, things got to get approved. Dude, nothing's going to happen. Just wait. Like that's how they always stop it. I think people thought, and I think Elon thought he would just be able to run free and just do all these things. And no. They're always there. They're always there to stop you, man. There's always checks and balances, and there's always a plan that's much bigger than,
Be a little skittish, be a little more cautious. That's what they get paid to do. Investors often have to place their bets before something takes place. Is this a buy? This unsettled market that we've witnessed recently?
Yes. In my mind, we put out a piece yesterday just talking about the 10 best days that happen every year. Last year, for instance, the 10 best days added up to 21 percentage points of the S&P.
Dang.
X those 10 days, the market was only up 4%. So, you don't get 20% years because it's good through the year. It's just the 10 best days. I think the setup for a 10 best day is near because if the economy's near stall speed, I think people realize the Trump put does come back because otherwise it has to unwind all this austerity. And if the job market's soft, the Fed put comes back into play because the Fed doesn't want to play with stall speed. And I think that's what is going to be the positive catalyst in the next couple of weeks. And on top of that, we already know stocks will bottom before bad news peaks. And so if we're seeing the market not fade on bad news, that means we're already priced in a lot of things that would scare us.
Well, we'll see what happens with the jobs report. What about positioning? I think you guys can be helpful to our viewers on where you think the best opportunities are after you've given your sort of macro, like you're giving your 30,000 foot view. Let's go down. Let's try and land this with ways to play the market the best we can.
My biggest sector recommendation this year has been healthcare. And it's weird because it's been the best performing sector year to date, but it's not exactly what I thought would lead. Stuff like CVS has worked. So, but I'm looking at that sector as the dreamiest of dreamy for AI productivity. There's so many inefficiencies, long-term margin expansion, and then maybe even ultimately, better news down the line on the drug front. I see estimates, bottom-up estimates are up in every industry in healthcare, tools, managed care, hospitals, drugs, biotech, yet the stocks were really bad for the last 2 years. They're up a little this year, but I think there could be runway there, and I like owning that dream of margin expansion in healthcare. I just think people are way too negative about the administration's ability to wreck earnings in that sector.
So where some would traditionally look at healthcare as a more defensive,
I think it could be
you're
both.
playing
Offense and
offense.
Yeah, I like offense and defense. I think it could be both. I think there's some names that have a lot of upside, and I also think it could be defensive. And I love these businesses that have a lot of employees, a lot of revenue, and low margins. And then what is AI actually going to do? It's going to predict customer behavior, predict employee behavior, and help these companies expand margins. And so there are all these businesses like McKesson and Quest and Cardinal and Cencora and Therm, go down the line that probably can grow their revenue over the next 5 years without doing a lot of net hiring, and then their margins go up. So I wouldn't be shocked if the next 5 years healthcare is the best performing sector over that period. And I like the fact that sentiment is, I don't think that on that side of the ledger right now.
What about you, Tom?
Well, year to date, before the correction, cyclicals were leading, financials and healthcare and international. And since February 19th, cyclicals have still been leading, healthcare has been leading, and financials. So I think that financials and cyclicals have actually been pretty strong through this correction. Healthcare has been actually a good call because it's held up great. But to me, I think there is too much fears of a growth scare because Germany's rally, I know it's understandable for valuation reasons, but really tells us that industrial stocks are okay and the ISM's actually still above 50. So I do think you want to be cyclical once we're through this correction.
I mean, the beige book today wouldn't have you, screaming growth scare. For more on that, let's bring in our senior economics correspondent, Steve Leisman. Is that the correct read? Steve, I know you can't look at the beige book and factor in tariffs because the beige book is already out and tariffs are...
Which has all the anecdotes from around the 12th Federal Reserve District, did find that tariffs and the uncertainty over fiscal policy are having a profound effect on the current situation and the outlook. As you said, the beige book said overall economic activity, it rose slightly, a kind of tepid characterization, with consumer spending lower on balance. But tariffs were said to have boosted uncertainty, with some reports that they already may be increasing prices. Again, as Scott said, this is before the tariffs took effect, but it was already out there. One bank reported that some plan to put planned investments on hold, increased cargo volumes, and was keeping home buyers out of the market, according to one report. The New York Fed, in its beige book report, said, quote, a manufacturing firm noted that either...
Yeah, I think, one of the worst things for the housing market, other than mortgage rates, is you got to understand when somebody goes to buy a new home, it's a huge confidence play. Huge confidence play. And anybody that's ever bought a home, you understand what I'm saying, right? Like, you got to have confidence in your future, in your job or your business or whatever to go make that purchase, right? You got to have confidence. And so if your confidence is negatively hit because you're hearing about tariffs and cuts on all these federal jobs and, what that could do to unemployment, and you're starting to get a little scared about the economy, you're not as likely to go buy a house. Like, it's just as simple as that. And so it definitely hurts the housing market, which makes it more attractive if you're a buyer, but certainly not if you're a seller, right? So that's just something to keep in mind.
Paying tariffs or adjusting sourcing to avoid tariffs would lead to higher selling prices either way. Firms said it was...
I think have some stuff for you. Start with Adam Parker.
I mean, a lot of the institutional clients for us were mentioning that kind of now casted GDP from Atlanta that looked much
down
worse.
2.8.
Right. So I think that might have been not emblematic, but there definitely was some chatter I was getting about that related to the growth scare a couple of days ago when things were selling off. One of the things that we tracked, the three of us were together on election night, and we all commented how the poly market seem to be very accurate in every election. And if you look at the poly market, there's a question out there for the probability in Q1 or Q2, there's a tariff that sustainably impacts a 5% or more. I think it says Mexico, China, and Canada. I can't remember. But we checked yesterday, and it was still less than 50%. So I think there's still some doubts that people have about the sustainability of this and how much it will impact. So I'm kind of with this notion that it impacts the management teams for a little bit temporarily, but not likely the actual ultimate economy and earnings trajectory. At least that's my take.
Tom?
Yeah, I mean, just to add to Adam's point, the uncertainty I don't think is causing a screeching halt to the economy, but I think it is suppressing demand and confidence. So that's why we are getting what looks like a growth scare, but that's why I think the Trump put and the Fed put actually come back into play.
Yeah, what do you think about that, Steve, what Tom puts forth for the second time already in our program, this idea of a Fed put? Right? They're not going to let the situation unravel. They don't, if 2.8 negative like Atlanta has comes to fruition, hello Fed.
I think that's right, Scott, but I'm gonna go for three. Three times the charm here, Scott.
Man, well, you know what they say, Steve? 3 strikes, you're out. And it's you who's going to be out.
That's okay. That's okay. I can go play guitar for tens and tens of dollars. But here's the thing. What bothers me about Tom's confidence, and indeed the market's overall confidence in the Fed right here, is when do you see them doing this? When is the Fed going to be confident that it has seen the tariff impact and that is passing through the economy and not leading to wider inflation? I think the overall call you made there is correct, Scott. That in the face of a negative print on GDP, really soft jobs numbers, that the Fed will be cutting. The timing is what bothers me, and the Fed's confidence that it's not seeing wider inflation is what bugs me, because I cannot imagine a month, and maybe Tom can correct me on this, where you have a 1 percentage point increase, for example, or even a 0.5 percentage point increase in the CPI, and the Fed is cutting that month in the face of an inflation rate that is already half a point above its target. I think it's going to be a very difficult thing for the Fed to do, to say, we're looking right through these tariffs and we're only focusing on the employment side of the mandate.
That's the great conundrum, isn't it, Tom?
Well, yes. There's a lot of alchemy in that process, right? So let's just think if it's the May window is, the probability is only 28% right now, but let's say that's the May cut that we want to think about. The reason I think you could see this move forward is, one, financial stability could become a problem if the market has a 10% drawdown. On top of that, confidence indicators actually tank. Then the Fed is not really thinking about the imputed inflation of shelter and, goods prices filtering through, but rather the idea of staving off an employment situation that could unravel very quickly.
What do you think?
I think we're 5,600 to 6,200 range bound here until we get on the other side of it. If I were answering Leisman's questions, I would have said they'll get confidence after April guidance, and the stock, I like Tom's comment about how the stocks react to that guidance. If they don't go down, and I think the companies are giving you a window for how they see the second quarter and into the second half, that'll probably be the signal. The Fed probably lags the equity market. I think most people like.
Yeah, I mean, the Fed always worries much more about recession and unemployment than they do inflation. Why? Well, the Fed is always very accepting of inflation in general. Like, remember, the Fed expects inflation, CPI, to usually be in the 2s. So they're already always expecting inflation. They always want inflation, right? Now, if it gets too out of control, that's where we start to have issues. Additionally, it's much easier to get inflation down than to have unemployment come back in any short amount of time, essentially, right? So you look back to the great financial crisis, right? And in a matter of a year and a half, we watched the unemployment rate go from 4 or 5% range to, where it topped around 10%, right? Now, it took years and years and years and years to ever get back to that 4 to 5% range, right? Many years. And so if you look at where the unemployment rate started to skyrocket versus when it got back to like that ideal kind of 4 to 5% range, we're talking about it took many, many years. Whereas inflation spiked massively, obviously, started at the end of 2021 and really went into 2022. They brought that down in like a year and a half, right? To more of a normalish range. It's not quite at target, but it's not that far away, right? You aren't going to all of a sudden have 10% unemployment and be able to magically bring that back, unless there's a freak situation like obviously Rona, where people were forced to leave their jobs if you were in the travel industry or something like that, right? And then the jobs came back because then travel opened back up. Some freak thing like that. Outside of that, you're not going to magically just have jobs come back suddenly. It doesn't work like that, right? So that's another reason that the Fed always is much more concerned about the employment market rather than, let's call it, concerned about inflation, right? So, which means if they see the economy weakening more, they're much more likely to cut. Okay. Alrighty, guys, appreciate you joining me as always. Thank you so much for being here. As always, thank you for being subscribed to the channel. Additionally, if you're looking to apply to join our private stock group, private wealth group, get access to 1000xstocks.com, my premium software I use each and every day. Pin comment down there, click on that, fill out a form, see if we can get you access maybe a little later on this week or maybe this weekend. Okay. Much love and have a great day.